Okay, so welcome to our second part of our discussion on week 9 or week 11, excuse me, chapter 7. We're going over a few problems that we were assigning for this week, and it'd be problem 718 or exercise 718, 720, problem 736, and then we'll discuss chapter 9, which is on financial statement analysis. So just added to the weekly course folder here for 4.8 was the week 11 solutions. The 4.821 class, which is what we'll be going over right now. And make sure I don't have anybody up. I do have someone else in the waiting room. So, okay. Okay, so exercise 718 is on page 281 of the textbook, and that's determining the amount of bond premium or bond discount on given bond issues. The first problem states that we have Gray Company that issues $80,000 worth of bonds at a price of 101.25% of face value. So anything greater than 100% of face value is going to be a bond premium. Anything less than 100% of face value would be bond discount. So in this case, our bonds were issued at 101 and a quarter. So to figure out the price of our bonds, we take the face value of $80,000 times 101% or 1.01, 101 and a quarter%, 1.0125. So that multiplication will give us $81,000 of proceeds that would be received for the bond issue. Subtract from that the $80,000 face value of the bonds, and what's remaining is any bond premium or bond discount. Premium in this case, since we're receiving more cash for the bonds than is the face value. Make sure I am not muted. Okay, good. So the first, our exercise 718, part A, bonds were issued for a $1,000 premium. The book gives you actually just kind of a shortcut to determine the premium and or discount, and that is to just multiply the face value times the difference between the issue price and 100%. Okay, so that's part A. Part B, Bush Company is going to issue $200,000 worth of bonds at a price of 97.5%, 97.5. So $200,000 of bonds times 0.975 gives us $195,000 is what our proceeds would have been. Subtract from that the bond face value of $200,000, and we're left with $5,000. In this case, we have a discount. Okay, make sure I don't have anybody else in the participants. Okay. So part B, our solution was $5,000 of discount on that bond issue, as the price was below 100, was below face value. So part C is Oak Incorporated, issues $100,000 face value of bonds at a price of 103% of face value. So $100,000 face value times 1.03 would give you 103% or 103,000. Subtract from that the face value of the bonds at 100,000. We're left with a $3,000 premium in this case. So that is our solution to part C. Part D, the final part to that problem is Willow Company, who issues $180,000 of 15-year 7% bonds at 99. So they're going to issue those bonds at 99% of face value. So face value times 99%. 178.2 would be the proceeds from the bond issue. Subtract from that $180,000 of face value, and the remainder is a $1,800 discount on the issuance of those bonds. So recap, part A is a $1,000 premium, B is a $5,000 discount, C a $3,000 premium, and D a $1,800 discount. Something like that would make a good exam question, hint, hint. Okay, so moving on to exercise 720, bottom of page 281, top of page 282. There are a total of 5 requirements in this problem. And what you're given in the paragraph before the requirements are that we have our company is Square Foot Grill Incorporated, issues $200,000 of 10-year 6% bonds. They were nice to you this time. It said January 1st, year 1. So that almost never happens in a bond issuance problem. So $200,000 of bonds issued January 1st, year 1 at 102. So 102% of face value. Interest is payable December 31st, so there will be no accrual of interest at the end of the year, which comes out very nicely. So our requirements are to, first of all, show the effect of the transactions on the financial statements for both the bond issuance in year 1, January 1st, and the December 31st, year 1 recognition of interest expense, which not only includes interest expense payment, but also includes amortization of, in this case, a bond premium. So then part B would be at December 31st, year 1, what is going to be the carrying value, which would be face value of the bonds plus any unamortized bond discount or bond premium in this case. C, what would be the amount of interest expense on the income statement? D, carrying value of the bond liability as of 12/31 year 2. So we'd have to do another entry for interest expense. And part E, what would be the interest expense on year 2's income statement? Okay, so first things first would be part A, the effect of the transactions on the financial statements. So complete the template, which is given, looks similar, should look about like what's given in A here. And we'll record, first of all, the entry of what would the bond issue look like in the expanded, financial statements model. The bond issue, the recognition of bond interest, and amortization of the premium. So part 1, number 1, is event 1, issuance of $200,000 of bonds at 102%. So to put some numbers to just the pluses and minuses here, $200,000 is our face value. Square Foot Grill would have received cash of 102% of that amount, or $204,000, which gives us part of what we need in part B, actually. So event 1 would be an increase to assets or cash of $204,000. in our liabilities, we would have both bonds payable in the, always showing the face amount of $200,000. And there'd be account that, and it pairs along with that bond account, the bond payable account, which would be premium on bonds payable. And that amount would be the difference between the cash received, 204,000, minus face value of 200,000. So we have a $4,000 premium on the bond issue. So that would be an additional liability account called premium on bonds payable. So immediately after issue, the what's called carrying value of these bonds would be the $200,000 face value plus the $4,000 premium. So in this case, it would be what was received for the bonds, but that's only immediately after issuance. So event 2 is to record interest expense at 12/31 year 1. 12/31 year 1, our interest paid out will always be the amount of the bond face value times the stated interest rate. So $200,000 face value times 6%. And we do need to take the step further and determine how long we're recording interest for. In this case, it is 1 year, so we don't have to do anything further. If we were recording interest for a period shorter than a year, we would multiply this number then by the fraction of the year of interest we'd be recognizing. So we will be paying a full year's interest. So principal times rate times time. Principal's 200,000. Rate is 6%. Time is 1 year, so 12 over 12 months. So $12,000 worth of cash paid would be the amount of cash paid for interest. So that would be our decrease to assets in part 2B. And then we'd also have $200,000 or $12,000. We would have $12,000 of expense, interest expense. However, that bond premium, the amortization, will reduce our effective interest. So $12,000, excuse me. So our bond payable, our premium, we started out with $4,000. We looked to the term of the bonds as to how much bond premium we amortize per interest payment. So the bonds premium will be amortized over 10 years and their annual payments. So we'll have 10 entries of reduction of the bond premium and actual reduction of the interest expense as well. So the effective interest, the interest expense recognized on the income statement, this is part C, would be right here, be the stated interest less the amortization of bond premium, which I just calculated. That much plus $12,000 of interest paid gives you $11,600. That would be your interest expense, which would be recognized on the income statement. And the good thing with straight line amortization of bond premium, the interest expense year 1 and the interest expense year 2, all the way up to year 10, are going to be identical. If you used what was called the effective interest method, which was in the appendix that we didn't go over, those numbers would not be the same. It would be all figured on the carrying value, which is kind of it's a different approach. This one, actually, it's a lot easier, makes a little more sense. So that's why we're sticking with it. It's less complicated. So immediately after the first interest payment, what would be the bond carrying value? we had that $4,000 bond premium. Whoops. After the payment, the first payment of interest, we amortized the bond premium. It reduced it by $400. So the remaining bond premium at the end of year one's interest payment would be $3,600, shown here. Add that to the bond payable, because since this is a premium, we are adding the two numbers. So the carrying value of those bonds at 12/31 year one is $203,600. So that's what this part here is, what would be shown on the balance sheet, almost verbatim without the calculations. Shown parenthetically. So again, like I mentioned, what you calculate in part C for interest expense year one, using straight line method. And since we have a nice neat January 1st issuance and December 31st payment, we don't have to do any accrual at the end of the year of less than a year's worth of interest. So our interest expense year one and year two, they're going to be identical. So you can pretty much almost just copy paste part C for part E. If the book asks you what's interest expense for year 9, it's going to be the same thing as C and E. So then that would leave the only part to deal with would be part D, the carrying value of the bonds at the end of year 2. So we would still have our $200,000 face value. That much is not going to change ever. The premium on bonds payable, that account's just going to get smaller and smaller and smaller and smaller as the bonds mature. We get to year 10, the premium on bonds payable will be 0, as we're reducing that account by an even amount per year of $400. At the end of 10 years, the full $4,000 of premium will have been amortized. So at 12/31 year 2, our premium on bonds payable, we would have started out with the balance in that account at $3,600. What was the balance at December 31st year 1? And we would amortize another $400 worth of bond premium in year 2. So we would be left with a carrying value between the bonds and the premium on bonds payable of $200,000 plus the premium of $3,200. Carrying value, the sum of those two numbers, $203,200. This is what would be recorded on the balance sheet pertaining to the bonds payable. Excuse me. Okay, so that is exercise 20. From there, we skip to one of the last problems in the chapter. It's actually like the next to last. Oh, no, there were 2 more after this. It was 36. No, 30. You say 30? Yeah, we did say 36. Making sure I got the right problem up here. So 36, it's a straight line amortization, but this time it's a bond discount we're dealing with. And they give us in the text a list of transactions. This problem had a bond issue which was not issued January 1st, unlike the problem before. So this time we will be recording accrued interest expense and amortization of bond discount for a period less than 1 year. So that's kind of why I wanted to go over this problem, was we deal with not quite a year's worth of interest. And that happens frequently when you have bond issues. So our year 1 transactions, we have year 1 and year 2. Year 1, we have the bond issue to deal with. The bond is issued for less than face value. Proceeds received less than face value tells us, part A, that we have a bond discount. Why do we have a bond discount? Apparently that 6% interest rate is less than what other investors could be receiving in other investments in the market. So to attract investors, we have to offer a discount on the bonds. Otherwise, probably wouldn't sell them. So we'll be actually paying an extra $6,000 of interest over the life of these bonds. So that much instead of the bond discount or premium that we saw in the exercise before, which reduced effective interest, this will increase our total interest expense. So the market rate of interest would have been less than our stated rate, which was 6%. So the bond had to be issued at a discount in order to be sold. Now, that's why in requirement A, that the market, that's actually the solution though to requirement A there. So requirements A and B. B, they ask us to prepare the liability section of the balance sheet for 2 years, for year 1 and year 2. Requirement C asks us to determine the amount of interest expense on the income statement for years 1 and 2. And then D, what would the amount of interest paid to bondholders be for both of those years? Interest paid will probably be the easiest one to deal with. Interest paid in cash. And you do have to also look at part year 1, the March 1st information. We not only have a bond issuance, which happened with into our current year in a couple months. So it didn't happen January 1st, happened March 1st. Not only is that the case, we also have semi-annual interest payments in this problem. We haven't dealt with that yet. Another reason I wanted to do this problem. So we have semi-annual cash payments for interest that'll happen on March 1st and September 1st. Beginning September 1st, year 1. We need that for Part D. So that's why these numbers are different between years 1 and 2. So the interest expense or the interest paid to bondholders for each bond, semi-annual bond payment would be the face value of the bonds, $200,000 times our interest rate, which was 6%. That's a full year's of interest. However, our interest is paid twice a year. So we need to divide that number by 2. So $6,000 will be our semi-annual interest payments starting September 1st, year 1. So in year 1, we only have one interest payment. In year 2, we will have interest payments for both March 1st and September 1st. So year 1 will have one payment of interest, year 2 will have 2 of them. And then year 2 through year, say how many? 8 years. So year 2 through year 8 would be the same. And then in year 9, there would be the other half. There'd be just one interest payment and then the principal. That'd be March 1st, year 9. Okay, so interest, how this will be shown in the balance sheet to begin with, we would have had $200,000 bond, subtract $6,000 of bond premium. So immediately after issue, the bonds payable would have had a carrying value of $194,000. So September 1st, what would the amount of interest? We would have paid $66,000. Now we have to come up with a discount on bonds payable. How do we do that? This is where our calculations down here are happening. It's right underneath the table. So discount on bonds, the amortization of the discount, we had $6,000 discount. Whoops, $6,000 would have been divided by, we would divide that total interest, or sorry, that total discount by 8 years. And really by 8 years and also 12 months. So 62.5, $62.50 would be the amortization of the bonds per month. So the discount on bonds payable, we would have amortized during year one, 10 months worth of bond discount, excuse me. So $62.50, $62.50 per month times 10 months. That first bond interest payment, we would have paid cash plus amortized $625 worth of bond discount. So at the end of 12/31 of year one, our $6,000 of bond discount has been amortized down to $5,375. So $625, the subtraction figure here is how much in bond discount was amortized during the year. Year two, you would have a full 12 months of amortization. So that's where the $750 comes from. So year one, the carrying value of the bonds is $194,625. Year two, the carrying value is $195,375. The carrying value will keep increasing. The discount itself will keep decreasing as closer we get to maturity on these bonds. So interest expense part C is really about the only remaining item we have. Interest expense reported on the income statement. Year two is not horrendous because year two is a full year's worth of interest, $12,000 of interest paid in cash, plus $750 of bond discount. So interest on a bond that has a discount, interest expense is greater than interest paid. The opposite is true with bonds issued at a premium. Interest expense will be less than interest paid. So the issue will be coming up with our year one bond interest expense. And that's calculated down underneath part D. So we first need to calculate the interest paid. It'd be the difference between the interest paid, I'm going into effective interest method, and we don't need to do that. So our interest paid and our interest accrued will both be part of interest expense. And our discount, we will amortize $375 worth of discount when we record that September 1st interest payment. And then there would also be amortization accrued, both totaling the $625 that was calculated in part B. So between the two, we are decreasing our bonds premium or discount, I'm sorry, on bonds payable by 10 months worth of amortization. Again, that amortization rate was, $6,000 divided by 8-year maturity divided by 12 months. Whoops, 12, not 11. So 62.5 times 10, times 10, not 1. So plus the $10,000 of interest that we recognize during the year, or interest paid and interest accrued. So our 10,625 would be the total of interest paid at September 1st. Our interest accrued, which would be September 1st to December 31st, which was 4 months out of 12. And the accrued interest would have been $4,000. So $6,000 paid, $4,000 accrued, plus discount amortized for 10 months is what yields our 10,625. On our income statement, we would show interest expense in that amount, $10,625, calculated as shown. So that's our 4 requirements that are given here in the problem. Okay, so that file is available up in our 48121 folder. Put it as the first file as we deal with that first. So then we'll now turn, since we've got chapter 7 kind of put to bed, we'll discuss chapter 9, which is on financial statement analysis. I already have that loaded. No, that's chapter 7. Let's just open it. Sorry, my phone was buzzing. Okay, so financial statement analysis, a tool commonly utilized by investors to make decisions about what company to invest in, also used by those that are in the business of lending money to make credit decisions. Do we want to lend to this company, or are they a risk in terms of their financial stability? So the way that's achieved is through financial statement analysis, which is basically involves a lot of ratios, but also involves examining multiple years of financial statements, not only of the same company, but of maybe one company to another in the same industry. So primary objective, this would be going back to chapter 1. Accounting is all about communication of the results of operations in order for stakeholders. They could be people that are within management of a given company, or external users like your bankers, like your investors, who are wanting to make some sort of a decision involving the company, as to whether, again, to lend credit, to extend maybe accounts payable privileges to them, an investor, whether they want to invest some money in the common stock or preferred stock, or a note payable, even like we just studied in chapter 7. So to provide information that is useful to these decision makers, regardless of who they are, we do need to consider what kind of users we have, first of all. That not only are the users of the financial statement information company management, there's also external users. People such as your creditors, your stockholders, possible investors, regulatory agencies. You could be dealing with someone like, the EPA, or, like we've seen recently, Small Business Association, with all of the pandemic aid. Excuse me. So the information needs of the users, those depend upon the decision at hand. So what one user is going to need out of the financial statements is not necessarily the same as another user. So accountants, they have to make sure they're providing enough information so that anyone who's utilizing the financial statements can make whatever decision is needed. Now, internal users like management, there may be additional reports that are provided to them, and that's more of a discussion about managerial accounting, which we do get a little bit into in this course, a little bit into things like cost. Those are details that aren't necessarily given in the form of financial statements, but more in the form of things like management reports, which aren't made publicly available. So information, analysis techniques, that's going to vary depending on who the user is and what information they're looking to glean from the financial statements. So there have been a variety of analysis techniques, ratios that are standard for different users. And also, not every user is the same in terms of their degree of knowledge of the financial statements. An accountant analyzing financial statements might be a little bit different than just, someone at Quill Corporation, which is office supplies, just deciding whether or not to lend the company credit. So we do employ one technique that's employed other than ratio analysis is something called horizontal analysis and vertical analysis. What horizontal analysis is taking one line of a financial statement and comparing the result from that line to a result from another period. So basically, you're going to be looking at just one line. Like in this case, we have the income statement for Milavec Company presented on the top of 329. We also have the balance sheet, which is presented side by side on the top of 329. So horizontal analysis, we would compare something like the sales account from year 3 versus year 2. How much did the result increase or decrease from one year to the next? If so, by how much in terms of absolute dollar or by percentage? So we'll employ both of those techniques in horizontal analysis. Vertical analysis would do the same. And in vertical analysis, you're comparing one figure on your income statement or balance sheet is used as a base. In an income statement, generally it's the sales figure. Every expense or other income figure is expressed as a percentage of that sales figure. So generally for a vertical analysis, you would see 1 year expressed in whole dollars and as a percent of that one benchmark figure. Generally sales on an income statement and in a balance sheet, the benchmark figure is generally total assets. So you'll see whole numbers and percentage figures as well. So horizontal analysis, vertical analysis, we also employ ratio analysis, which we will go through many of those ratios, and their ratios are carved into separate categories as to what ratio, what does this ratio measure? Does it measure a company's liquidity, ability to pay debt, income per share. So we got things like solvency ratios, measures of profitability, liquidity, stock market ratios, etc. There's many different categories, each of which we will discuss separately. Okay, so the starting point would be our financial statements, and generally to do financial statement analysis, you would be presented with multiple years, 2 or more. Especially for completing horizontal analysis, you need more than one. could be 1 year, could be the same period from the year before. Maybe you could be doing a income statement for the month of February 2021 versus the month of February 2020 and comparing the two horizontally and or vertically. So horizontal analysis, again, that's following just one line across in a financial statement, analyzing that as a comparison between one period versus another. So also called trend analysis. It's looking at the behavior of an individual entry on one of the income statements or income statement, balance sheet, cash flow, statement cash flows, could be any of those. The trend could either be, that's studied could either be as an absolute dollar amount or percentage or both even. So an example, we take this, our comparative income statement from Milavec company. We're going to condense the operating, it's when we did condense the operating expenses already, but we condensed cost of goods sold into the one figure of 610,000 for year one, 480 for year two. So we shortened the financial statement a little bit because we didn't really need to analyze all that detail involved in the cost of goods sold calculation. Excuse me. So how we get these percentage differences is the big question. We're using year three as a basis. So our sales are going to be expressed as a percentage of year three, year four versus year three, but as a percentage. So what you would do is take $900,000 year four sales. You can use the approach that is employed by the slides here, and that is to take the year being analyzed minus the benchmark year, divide that quantity divided by the benchmark year. Another option is to take the current year, divide by the prior year, and subtract 100% and express as a percentage. A different way to get you to the same place. So that trend analysis was done for all of the figures which were on our income statement. So our year four sales increased 12.5% from the year before. So then would be the question of why and a further analysis as to why. Perhaps the company engaged in more advertising during the year and it was effective. Perhaps there's, some sort of a trend in the marketplace that there was a higher demand for the product. Just, kind of like this year with, building materials. Cost of building materials has gone up exponentially just because of detail or both demand and supply. There's been a supply dip and a demand increase, and that's driven the price way up. Client of mine told me that plywood currently is about 5 times what it was last year. So a little ridiculous. I guess a plywood that was $6 is now about 30. Okay, so the same was done for our expenses. Yes, our sales increased, but our gross margin decreased by 9.4%. The reason for that would be, hey, we had a cost of goods sold increase as well. So first step would be to get the percentage differences. The second step would be to maybe analyze even further if you are company management and determine as to why did those numbers increase? Was it just a price increase or were there additional factors at play? Okay, so percentage analysis, again, you do choose a base year from which to calculate all increases or decreases. Or you can use a percentage change from the preceding figure. That happens when you have more than 2 years being presented. So if you're talking, year 1 through year 4, then you're not going to use year 4 as a benchmark for year 2. You might be looking at a percentage increase between year 1 and year 2. Okay, we'll use year 1 as that benchmark. Year 2 versus 3, we'll use year 2 as the benchmark. So it depends on how many years of data or periods of data you have to analyze as to which approach you would take. Or you could instead use year 4 as a basis and express all of your increase as one figure. But it is good to do both approaches. Gives you a little bit better of a picture. Okay, so vertical analysis, same financial statements, except we're going to pick one figure on the income statement and the balance sheet and use that as our benchmark. Every item on those statements will be expressed as a percentage of that one figure. You're doing vertical analysis in Excel. This is when absolute cell references come in extremely handy in typing your formulas. Okay, so vertical analysis, we're comparing elements of the financial statements within themselves. So horizontal analysis, we're looking at one period to another. Vertical analysis, we're comparing within one period. So our cost of goods sold, what percentage is that of our total sales? Wages, what percentage is that of our total sales? So we would use more of what's called a common size financial statement. We will condense our traditional financial statements down into the key components. So once again, we didn't need all that detail, which was given on page 329, exhibit 9.1 in the income statement there. So we don't need the beginning inventory, purchases, ending inventory. We just want to look at cost of goods sold as a percentage of sales. And we might do this for more than one period. We have year 1 versus year 2 or 3, versus year 4. So we can look at our financial statement items as a percentage of sales. This comes in handy when you have 2 years which are of absolutely not even close to the same amount in terms of dollar amounts. You say you had a phenomenal year in 2020, like a lot of, like garden centers had just incredible years because everyone was home and wanted to do things with their homes and were landscaping and doing all sorts of things like that. So garden centers, hardware stores, any construction companies, they were busy. So to compare two financial statements of just completely different years, vertical analysis comes in handy because everything is expressed as a percentage, and you can see whether your expense items increased as a percentage of sales or whether they decreased. So just looking at Milavec company between year 3 and 4, something happened year 4, which drove up our cost of goods sold. So management may have a meeting about that and determine, well, maybe we need to increase our price as a result. Because our price is not being increased as a percentage of sales, maybe what it should be. Our gross margin is down, but what saved that company is they lowered their operating expenses somehow. Just happened to come up with the same exact net income as a percentage of sales. So that was some good company management there. So not only would you look at cost of goods sold increased, the next step would be to say, okay, why did cost of goods sold increase? So that would take some more investigative journalism on management's part. Okay, so of a balance sheet, income statement, total sales will be your benchmark figure. Every income statement item would be expressed as a percentage of total sales. For a balance sheet, that benchmark figure is total assets. For both the asset section and the liabilities plus owner's equity section, or stockholders' equity. Okay, so ratio analysis is the main part of this chapter. What does ratio analysis accomplish? Looks at relationships between different items in the financial statements. Might be items on two completely different financial statements. We might be looking at, total assets versus total sales. So we're getting items from, again, two different financial statements. So what is the use of ratio analysis? For a creditor, they're looking to see whether this company is paying their debts on time. So they're looking at, debt statistics. Creditors and stockholders, they're looking at more like, maybe looking at some debt statistics as well, but they might also be looking at things like dividends. How much dividends does this company pay? And also for any, past earnings performance would be analyzed. This could be, again, debtor or creditors, stockholders, company management. Company management will also do this. So ratios, 5 main categories, starting on page 333, going pretty much to the end, almost the end of the chapter. Go all the way to page 344. And then there's just a little blurb, and then that chapter ends. So the rest of this chapter pretty much will deal with ratios. Not only what they measure, but how you calculate those ratios. So some of the most, the categories are working capital ratios. Actually, sorry. We have liquidity ratios. We have solvency ratios. There's profitability. There's stock market ratios, and then there are other ratios. That's really our 5 main categories. Liquidity ratios, there are 5 of those that are most common in practice. There are others, but it kind of tends to be overkill once you get into some of the more nerdy ones. So working capital, very commonly used. That's not really a division, that's just a subtraction. Working capital is just current assets minus current liabilities. And what that ratio measures is how much after the payment of current liabilities would a company have to contribute to its operations. Should be a positive number. That is what anybody's looking for. Company management, definitely creditors, and absolutely investors want to see a positive number for working capital. So your current assets should be greater than your current liabilities and by more than a little bit, hopefully. So this company in 2 years, if you look at the working capital, it has improved its working capital by $20,000, about 20% from the year before. So we've got a favorable trend that is happening if it keeps up. So working capital, just current assets minus current liabilities. Now the current ratio takes those same figures, current assets and current liabilities, and divides the two. So our current assets, our current ratio for Milavec company, we had current assets of $168,000. we have current liabilities of $46,000. So current assets divided by current liabilities. So our working capital, or sorry, our current ratio, our current assets are 3 times what our current liabilities are, 3.65 times. So when you get to ratios, you can compare companies of completely different sizes. Yes, Milavec and LaRoque companies have the exact same working capital, but LaRoque's current assets are over 2 times what Milavec's are. And if you did ratio analysis on Milavec versus LaRoque, Milavec had a current ratio of 3.65. LaRoque is not as much. Our current assets there, $500,000, divided by current liabilities of $378,000. LaRoque has a current ratio of only 1.32. So in terms of working capital ratio as a percentage, Milavec has a better percentage than does LaRoque. So that might be one item in the plus column for Milavec versus LaRoque if you were doing analysis as to whether to invest in these companies. So there's something called the quick ratio or acid test ratio. That is a measure of immediate debt paying liability. So if all of our current liabilities came due right this very minute, could we pay them? Yes or no? Quick ratio, if the result is 1 or greater, the answer is yes. Less than 1, the answer is no. So only quick assets are involved, and what quick assets are is cash and marketable securities. That is our quick assets. And that cash receivables and marketable securities. So we'd have to call everyone with accounts receivable and say, hey, pay us. Pay us right now. We need the money. So that is our quick assets. Again, cash, receivables, marketable security. Those are the only certain current assets are what are called quick assets. Cash can be converted to cash relatively quickly. So those are a measure of liquidity by a company. These are all liquidity ratios. And that's how solvent is the company. Is it able to meet its current obligations? Okay, so quick ratio, if we looked at quick ratio versus year 1 or year 3 versus year 4, our year 4 current ratio was higher, but our year 4 quick ratio is lower. So we might have something happening in the trend, like maybe we have more accounts receivable outstanding as of year 4, and that would be a source of analysis. Would we need to maybe step up our collection efforts? Do we need to do something with our credit terms, make those a little bit shorter, offer discounts in order to carry less accounts receivable on the books? So those are all things that management would decide, but one thing that might make them decide yes or no is, again, quick ratio. So then we have accounts receivable ratios, and there are a few different ones of those, 2 presented in the text. One is called the accounts receivable turnover, and from accounts receivable turnover, we can calculate a second ratio, which is average number of days to collect the average accounts receivable. So accounts receivable turnover just measures how many times per year is the average balance of accounts receivable collected. So how quickly are we recovering our accounts? Average days to collect receivable is how many days does it take the average customer to pay their invoices. The lower the number for average days to collect receivable, the better. And the higher the number for accounts receivable turnover, the better. So if we put some numbers to accounts receivable turnover, you have to have your credit sales, your net credit sales. If a problem does not give you net credit sales, you have to assume that all those sales are made on account, that they're all made via credit, none of them are cash. To come up with average accounts receivable, that's just accounts receivable at the beginning of the year or at the end of the prior year, plus the balance of accounts receivable at the end of the year. That sum total divided by 2 gives you average receivables. And they did note in the year 3 calculation that the year 3 beginning receivables was taken from year 2 financial statements, which were not even in the book. So that's how 55,000 it was not presented. That would be a number if you were looking back in the material, you would not find it because it's not presented anywhere. So our average receivables from year 3 to year 4 did decrease, which is a good sign. We're carrying less accounts receivable on the book on average. And so our accounts receivable turnover, and we had more sales from year 4 versus year 3. So good indicators here that the average receivables, net credit sales divided by average accounts receivable. So 900,000 divided by 53,000 would give us the 16.98 in year 4, excuse me. So accounts receivable turnover, year 4 versus year 3, year 4 is a greater number. So more sales, plus we're collecting faster. That's a good sign. So whatever the credit department is doing to make that happen, keep it up because it's working. So then accounts number of days to collect receivables. What we would do here is take 365 days, 366 in a leap year, divide by the total, the accounts receivable turnover. The book did not do that. So for year 4, we would take 365 divided by 16.98, the result of 21.4, 21 days on average to receive a customer account receivable. And then you would look, is that, better than or less than, what your credit terms are? Do you expect, payment within 10 days, 20 days, 30 days? So are the customers, meeting the credit requirements? If not, maybe those need to be tightened a little bit. So versus year 3, the average days to collect accounts receivable. Whoa. I don't think that's right. That was 800,000. 365. Wait. Sorry. 365. Got on the wrong foot here. 365 divided by accounts receivable turnover. So year 3, our customers took about 25 days to pay accounts receivable versus 21 in year 4. So good indicator there. Customers are paying more quickly. So then going from solvency, another measure of liquidity ratios is inventory. So we do have some inventory ratios, and there are basically 2 presented in almost every most categories of ratios that are given. So we have inventory turnover ratios and average days to sell inventory. Kind of similar to what we saw with accounts receivable. So inventory turnover, how many times a year can we sell our average level of inventory? And the blue does indicate, and it is true, that there is a fine line between too much inventory and too little. You don't want to run out of stock, but you don't want to warehouse a ton of stuff that isn't moving either. So the quicker the inventory turnover, the better, to a point. If you're carrying so little inventory that you're frustrating your customers, that's not a good thing. So to help analyze how we manage our inventory, we have a couple of inventory turnover based ratios. So inventory turnover calculation is cost of goods sold divided by average inventory. So cost of goods sold, there's a number from the income statement. Average inventory would be, two figures from balance sheet taken as an average. We're picking items off of our financial statements and using those in this analysis. And then the inventory turnover ratio is used in determining the average days to sell inventory. So putting some numbers to, first of all, the inventory turnover ratio. Again, it's cost of goods sold divided by average ending inventory or average inventory. And average inventory, much like average receivables in the receivables turnover, is determined by taking your beginning balance of inventory, ending balance from the year before, adding to the ending balance in the current year, add the two, divide by 2. So, and once again, year 3's beginning inventory comes from financial statements, which are not presented in the chapter. So $40,000, again, that's a figure you're not going to see going back through the material. So it was given to us. So inventory turnover from year 3 to year 4 decreased. So that's kind of curious. That would be a good question for like your sales manager or whoever's managing your inventory. Did we have a lot of spoilage? Did we have, a lot of theft? What was the problem? Or are we just carrying goods that our customers aren't buying as much of? Do we need to not have so many of those items in inventory and instead stock items which are moving faster? So all of these lead to questions that can be asked of our different managers. So solvency ratios mainly deal with debt, deal with not short-term paying, but long-term paying ability of debt. And financing structure. Are we financing most of our assets through the issuance of debt or through the issuance of stock or operations? So, creditors, they're going to be concerned, hey, can this company meet its obligations? Stockholders like, nah, we care about the company's solvency in the long run, if that company can meet its obligations in the long run. If the company cannot, then as a stockholder, are you looking to bail out of your investment in the company? Can't happen. So some of the commonly used debt ratios, we have debt to assets ratio, debt to equity ratio. And this is, once we finish that discussion, that is where we will stop for the day. So debt to assets is total liabilities divided by total assets. What that measures is how much of a company's assets are financed by debt obligations, so notes payable. You don't want that to be too high of a number, but you don't want it to be too low either. So, a company that owns all of its assets outright, yeah, that's nice, but, are they leveraging debt the way they could? So debt to equity is total liabilities divided by stockholders' equity. So are our assets mostly financed by debt or by equity? So debt to assets and debt to equity ratios, total liabilities divided by total stockholders' equity gives us our debt to equity ratio. And debt to assets is our total liabilities divided by total equity. Or total, excuse me, yes. Total stockholders' equity. So we'll stop right here. We'll pick up with times interest earned, which is kind of an oddball little ratio. And so what we'll go to here is what exercises we'll discuss next time, and then pick up the rest of material. We have a number of more ratios to discuss, and that would be for Tuesday. So we're going to discuss exercise 9.1, which deals with horizontal analysis. Asks you, given 2 years of information, to compute percentage changes within an income statement and around percentages to 1 decimal points, and comment on any of the percentage changes that you noted. Okay, so 9.2a is a vertical analysis. And what's asked there of you is to just express each income statement for each of the 2 years as a percentage of sales and round to 1 decimal point. No further analysis needed on that one. 9.6 is computing working capital and current ratio. And 9.9 is a little bit of a comprehensive analysis. And actually, we'll go over that one together. So we'll just talk about 9.1, 9.1a, 9.2a, and 9.6a, and we'll go over 9.9a together. There's just some items which are missing. So that's where we end for today, and so we'll pick up with times interest earned after we go over our assigned problems or assigned exercises. Then we'll finish the chapter, and we do have exams set for the 15th, and we'll do some material and discuss that. So if there are no questions, then I will stop this. I will do a recording. I'll post the recording to the same page on Sakai of the Zoom session, and we will see you then on Tuesday. So hope everyone has a great day. Bye-bye.